A very good morning to everyone, and thanks for attending this session, What SMSF Accountants Need to Know About Insurance and Death, which on the face of it may not sound like the most exciting topic. In a moment I'll explain why it's relevant to everybody. We have over 60 people having registered today, and most of you are now online. So thank you very much, and a big thank you especially to those of you over in Perth and Western Australia where it's still very early in the morning, so thanks for joining us from over there. I will be sending out a copy of the slides and also, if we can get the technology right, the recording after this session, so just sit tight for a few days and that will come to you soon. My name is Greg Einfeld. I'm the owner and the founder of Lime Actuarial. We're in the business of providing very fast and easy and low-cost actuarial certificates for self-managed super funds. And I also like to help educate as many people involved in the SMSF industry as well, and I'll explain why. Firstly, let me start with a story about why I started the Lime Actuarial business. I became involved in the SMSF industry because I wanted to help real people who were trustees of super funds in better managing their funds and taking advantage of some of the many strategies that are available to trustees of SMSFs. And in providing that advice, one day I needed to obtain an actuarial certificate for a client, and so I hunted around and I looked at all the different options available, and all of them did the job. They all produced certificates, but I did feel that some of them were a little bit pricey, and some of the time the turnaround was a little bit slower than I would have expected, and I thought that I could do a better job. So the very next day I decided to start the Lime Actuarial business. And one of the great things about our business is that we can analyse data. We see lots of data coming through from the certificates, and I can see what accountants are doing. And when I see that, it often triggers a little spark in my mind saying, wow, this accountant could do this or that, or maybe there's a financial advisor involved as well. And if they made a few changes, then their client could be in a better position. So I want to share some of my thoughts with you in terms of what I see that's coming through in the data. So, as I mentioned earlier, I'm delighted to have 60 people having registered this morning. It just helps me share the message that I'm trying to spread about how we can all improve the way that self-managed super funds are run, and I really do encourage you to take on board a lot of the things that we talk about today and embed them into your own practice. Now, I'm going to be talking today about things that are relevant to absolutely everybody. And how do I know? I know that because there are only two things that are certain in this world, and we all know what they are. The two things that are certain are death and taxes, and we're going to be talking about both of those things today. So keep that in mind, and for that reason, this is relevant to all of you. And it may not be that you have one of your clients dying every year. Hopefully you don't have any of your clients dying this year or next year, but inevitably it will happen, and it's good to be prepared for it when it does. So these are the topics that I'm going to cover today. We're going to talk about establishing a fund and some of the insurance issues that arise. And then we'll talk about the insurance issues that arise when you buy property in super, or when your client does. And then we're going to switch to what happens when one of your clients actually does pass away, and some of the tax issues that come up, and then also some things to consider when you're paying a benefit, and then some concluding comments at the end. As far as questions are concerned, feel free to ask any questions using the question box in your control panel, and I'll answer those at the end in the same order that they are asked, and I'll hang around for as long as I need to. The objective is to finish in less than an hour. So it's now just after 10:30 in Sydney, so the objective is to finish by 11:30, but if there's lots of questions, I'll keep going for as long as we need to in order to make sure that all those questions are answered to the best of my ability. So why don't we make a start? And the first thing I'm going to talk about are the insurance issues when you establish a fund. Because what I see is often an accountant will recommend to their client, why don't you start a self-managed super fund and roll your balance in, without necessarily considering insurance. So I've grabbed a copy here. This is off a member statement from July 2011. This is a real member statement, and this particular member had a superannuation benefit of $653,000 and an insurance component on top of that of another $914,000. And if this particular member had been told, go and put your money into an SMSF, what's going to happen is they're going to lose their insurance. And the member's probably not even thinking about this. They might have known they had an insurance in place, it's not top of mind for them, and suddenly they realise that they've lost their insurance, or worse still, they don't realise and it becomes too late and they get sick and they can't apply for insurance again because the insurer won't take them on anymore, and they've lost that opportunity to have that insurance. So this is a real problem, it's a real issue, and I would say that in probably over 70 or 80% of SMSFs being established, the members are losing their insurance. So this is really problematic. So the question is then, what can we do about it? So there are some very smart advisors that came up with a solution to this problem, or at least they think they're very smart, and I'll explain why they might not be in a moment. But they started off being very smart, and they said, what we're going to do is we're going to roll over most of the superannuation benefit, and we're going to leave a little bit behind just to pay the premiums on the insurance. So they might leave, say, $5,000 or $10,000 behind. And in this case, what the member did was they rolled over just about everything. They left about $10,000 behind in the super fund, so that by 2013, this is what their member statement looked like. This is exactly the same fund. You'll see the amount of the insurance component there is exactly the same, of $914,000, but they've only got about $10,000 in their superannuation benefit, because the rest was rolled into a self-managed super fund. And so this member's sitting there feeling pretty good about themselves. They've still got their insurance in place, they've got their SMSF, they've got the best of both worlds. Or do they? So let's have a look now at what's happened since then. And there was a very clever advisor that suggested this back in 2011. The whole world's cottoning onto this strategy now. In fact, even the media has. Whenever it's in the media, you know that everybody else already knows about it. And this is just a screenshot from an online website, the Smart Investor website, which is part of the Financial Review Group. And it says, for this reason, many people who have established SMSFs decide to retain a small balance within their industry fund to take advantage of the cheap insurance. So the media's suggesting exactly what just happened in that fund. So what's happening now is the industry funds and many of the super funds are cottoning onto this. So I'm going to ask you all a question, and that is, which super fund in Australia has the most members? And so hopefully you can all see the question there, and I want you just to tick the correct box, which super fund has the most members, and we'll see what comes up. About half of you have voted now. Okay, I'll just give you a couple more seconds to get your votes in. 80% of you have voted. I think that's a quorum. So we'll close the poll. And I'm going to share the result with you. And there's two very strong leaders there in terms of the results, AMP and Australian Super. So I hope the many votes for AMP aren't what we call the donkey vote. You might remember in the Australian election last year that one of the parties, I think they're called the Liberal Democratic Party or something like that, and they got a seat in the Senate because everyone thought they were voting for the Liberal Party, and they were in the first column. So I'm not sure if that's what's happened here. AMP is certainly a very large fund and has a lot of members, but the fund with the most members is Australian Super. So let's hide the poll, and hopefully now you can see my slides again. Can I just have a show of hands for you just to confirm that you can see my slides again as opposed to the poll? You should see a slide that you should now see a slide that says Australian Super. So if anybody can see that, can you just give me the show of hands if that's okay? Great, we've got 15 hands raised, so that's plenty. Thanks. You can unraise your hands now. So thanks for that. So yeah, Australian Super is the largest fund in the country. AMP is certainly very big as well, and the others, BT, Colonial, and MLC, have got lots of members too. Australian Super has 2 million members, $75 billion of assets, and there's over 200,000 employers contributing to this fund. What's interesting is, with 2 million members, the chances are, if you're setting a self-managed super fund up for a client, 1 in 4 funds that you set up will have a member who was previously a member of Australian Super that's going to be rolling money in and could potentially be losing their insurance from Australian Super. So what I'm about to discuss is not unique to Australian Super, but the point I'm making is what I'm about to show you is being used in the largest fund in Australia and in lots of other funds as well. So let's have a look at what Australian Super has done to mitigate this problem that I just described. So this here is some policy wording from the Australian Super product disclosure statement, and it starts off, when does your insurance cover stop? And then let's go down to the red box. Income protection cover ends 13 months after blah 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 the last contribution was made. And for death and TPD, it's a similar story. It ends 13 months after your last contribution, and then when your balance falls below $10,000. So what's happening here is this strategy of leaving about $10,000 behind, or $5,000, isn't going to work in the future for funds like Australian Super. And more funds are cottoning on to this particular strategy, and they're saying, well, sorry about that, they're saying, if you want to try and game us by taking all your money away, we're going to have the last laugh because we're not going to pay your insurance benefit. We'll still deduct your premiums, don't worry about that, but we just won't pay the insurance benefit, which is ultimately what you're there for. So you have to be really careful if you're leaving a small amount of money behind in the super fund, that the super fund will actually pay the claim. And of course the super fund can change the rules on you at any time. So just because they have one set of rules today, it doesn't mean that they'll have the same set of rules again in the future. So you have to be really careful with that. And I suppose the key message here is that your client does risk losing their insurance when they start a self-managed super fund. And if they do, they won't even think about it at the time, but it's that they are going to think about it when it's too late, even when they've become unhealthy and they can't get insurance anymore, or worse still, when you have the grieving widow knocking on your door saying, what happened to my husband's insurance, or vice versa, of course. And I don't think any of us want to be the ones that say to the grieving widow, look, the reason your husband lost his insurance is because I advised him to set up the self-managed super fund and I didn't really think too much about insurance. Because I can assure you that if that happens, then your client, or at least your client's spouse, is going to be blaming you, and none of us want to be in that situation. So think really carefully about insurance when you are setting up a fund, and make sure that your client is aware of the fact they might be losing their insurance and how they can solve that problem by perhaps seeing a financial advisor and having the right insurance put in place for them elsewhere. So we're now going to move on to the next section of the presentation, and that is, what are the insurance issues when you buy property in super? Just having a look at questions. We haven't had any questions so far, which is fine, but do feel free to ask any questions as we go along, as I mentioned earlier. So let's look at buying property in super. What we have here is a pretty typical balance sheet for a self-managed super fund which has bought property in super. I'm not an accountant. I hope I've got the assets and the liabilities on the right side. I'm not sure about that, but I'm sure you can all follow what the balance sheet is saying. And this is pretty typical. We've got a property here on the left that's worth $600,000. we've got two members, John and Mary. They each have $100,000 in their balance, and there's a loan of $400,000, and there's no other assets in the fund apart from the property. In reality, you might have a small amount in cash, but it won't be very much. So I think you'll all agree that's pretty typical. Now we then face the situation where John, the husband, has passed away. And the problem is that the fund doesn't have any cash to pay out John's benefit. So unfortunately the fund is going to have to sell the property. Now that may or may not be a problem, but I'm sure it's something that John and Mary hadn't really considered. And it may very well be that Mary wanted to keep that property even if John wasn't still around. So using that famous old line from the movie Apollo 13, Houston, we have a problem here in this fund. There's no cash to pay out John's benefit. Okay, so there, what happens if John dies and what are we going to do? So let's move on. The good news is, or at least we think it's good news, that the SMSF owns some insurance policies. And let's have a look at the policies that the fund owned. They had two policies in place. The first one was on John's life, and the premiums were deducted from John's account, and the second one was on Mary's life, and the premiums were deducted from Mary's superannuation balance, and each policy was for $1 million. So you might look at that and say, oh, that's all fine, there's plenty of insurance there to pay out John's benefit. And I think you'd also look at that and say, yeah, that's how we normally do it. We normally deduct the premium for John's insurance from John's account and the same for Mary. So that all seems at the surface to be the way that we would do things. However, we still have a problem here because, as you can see on the left now, we've got the proceeds of the insurance, we've got $1 million in cash sitting in the fund, but because the premiums were deducted from John's account, the insurance benefit has to go into John's account as well. So we've added that $1 million into John's account, and he's now got $1.1 million. He's got his original $100,000, plus he's got $1 million from the insurance. He's got $1.1 million, and that benefit needs to be paid out of the fund as a death benefit. So we still have this cash shortfall. We still have more money in John's superannuation account than we have in cash in the fund. So the fund, despite having the insurance, is still going to have to pay out that money, and it will still have to sell the property. So I say here, Houston, we still have a problem. We haven't solved our underlying issue. And I think that most of you, if you look at the way that insurance in your funds is structured, would be in exactly this situation. So what is the alternative to this? What is the solution? Well, what we're going to do is we're going to put another insurance policy in place, one for John and one for Mary. This is numbers 3 and 4 at the bottom. We'll have a sum insured of $100,000 each, and you'll see that the policy on John's life will have premiums deducted from Mary's account and vice versa. And what that means is that when John passes away, because the premiums were deducted from Mary's account, the benefit is going to go into Mary's account as well. So now you'll see we've got cash of $1.1 million. We had two policies on John's life, one for $1 million and one for $100,000. The $1 million benefit went to John's account, and the $100,000 benefit went to Mary's account. So John now has $1.1 million in his account, which needs to be paid out, but there's $1.1 million of cash on the left-hand side to pay out John's benefit. So now we're in a much, much better situation. We solved the problem. I would make a couple of comments to keep in mind when you use this approach. Firstly, the premium is not deductible on that $100,000 policy because it's on John's life and it's coming out of Mary's balance and vice versa. That's a small price to pay. If you think about the cost of that $100,000 of cover, it's pretty low. The tax deduction would have been 15%. So the deduction you're missing out on is really very small, and I don't think you should be too concerned about that. Something else to keep in mind is the numbers here balance out perfectly, but what if John's balance had gone up a little bit, perhaps because the value of the property had increased and was marked to market? So it's probably a good idea to have a little bit of a buffer. Don't just take out $100,000 on each life. Take out $150,000, have a bit of a buffer just in case the value of one of the members' balances does increase. So there's a really good strategy to put in place when your client has property in super to ensure that the property isn't sold. Now, I did mention before that this might be an investment property, a residential investment property, and they might be very comfortable in selling the property. I'll come back in a minute to what happens in some other situations. But some of the implications of what we've just discussed here, it's really important that accountants work closely with financial advisors. This has to be a team effort. This is, firstly, the accountant recognising the risk and the problem here. Secondly, referring their client to a financial advisor who then has to understand this strategy as well and put in place all of those 4 policies that I mentioned earlier. And then the work needs to go back to the accountant who has to make sure that this is accounted for properly. And that means that if you're delegating work to staff in your team, that they need to be educated. And if you do have a close working relationship here between an accountant and a financial advisor, this is a brilliant way of demonstrating to your clients the benefit of having that working relationship. Of course, the next implication, very carefully consider when you're deducting insurance premiums from a member's account, which account to deduct them from. And I'd say go above and beyond that and put some minutes in place as further supporting evidence of where the premiums were deducted from and where the benefit's going to be paid to, just so there's absolutely no doubt whatsoever, and the tax office can never dispute this, and your auditor can never dispute it either. So I mentioned a second ago it could be a residential property, but what if it's a business property? What if the family business is, say, a cafe or a restaurant, and they own the property in the super fund? And not only now has John passed away, but the fund needs to sell the property that is the livelihood of the family business too. So it's really critical to have these strategies in place and to make sure they're all accounted for properly. So the conclusions out of this section. Firstly, your client may need to sell their property if one of the members dies. Secondly, and I'll make this point once again, the normal insurance structures don't solve the problem. You need something a little bit different here, and this is how you demonstrate to your client that you're a real SMSF specialist, because most people aren't doing this, and most people's clients are going to have this problem. And then finally, who's the client going to blame if they lose their property? Once again, this is where the grieving widow, or widower for that matter, is going to point the finger squarely at you if you're not able to get this right. So keep all of those things in mind. So we've now covered the first 2 topics, which are about putting insurance in place, and they're the precautions that you take before your client passes away, and hopefully you've put all of those precautions in place. What we're going to move on to now is what happens in the unfortunate situation where your client has passed away, and as I said earlier, let's hope this doesn't happen in the near future, and let's hope it doesn't happen too often, but inevitably it will, because death is one of those things that catches up with all of us at some point in time. In fact, I had a very insightful email from one of our clients who's an accountant. Phil, I'm not sure if you're on the call or not, but if you are, then we had this email just a few weeks ago, and he was looking at his own particular fund and his own family, and he said to me, Greg, what happens if I'm not around anymore, who's going to continue to run my fund, and what tax is going to have to be payable, and how's my family going to look after it, and how's the handover on my fund going to be done, because there's no one there to look after it, and I won't be here to explain to everyone how it works, and lots of questions like this. So these are really good questions to consider, both for yourselves and for your clients as well. So let's have a look at some of the tax issues. Now, I do want to mention here that the tax on death is complex, especially if there's an insurance policy involved. But even if there's not, the tax on death can get complex. And what I'm sharing with you today covers the most likely situations. There are some obscure situations that are not covered by what I'm discussing today. And so please do keep that in mind, and if you do come across this situation where one of your clients has passed away and you're not sure what to do, it is really suggested to get some advice from someone who's a real specialist in this particular area. Okay, so it's always good to attend a webinar like this, but I can't cover all the issues in the space of probably 15 minutes on this particular topic. Okay, so let's have a look here. So I'm going to start off here by just showing you what a typical member statement would look like, and in the top right corner you'll see that there's these different components: the tax-free, the taxable taxed, and the taxable untaxed component. This is important to understand because they all get taxed differently upon death. If your member reporting to your members does not single out these components, then you're probably not providing the best possible service to your clients, and they're going to strike a problem when one day they do need to start taking money out of the fund, because they won't know how much tax to pay, and you won't be able to calculate it for them either. And I think all you'll be able to do is make the conservative assumption that everything in there is a taxable component, which could end up costing them tens or even hundreds of thousands of dollars in tax. So if you're not splitting these components out, I'd suggest you should start doing so. And if you're not sure how to do so, then you may want to attend our next webinar. I'll talk more about that in a moment, which will be in a week from today. Or feel free to give me a call and we can have a chat about how you solve that problem as well in a reasonably low-cost manner. But the key point here is make sure that you are splitting these components out for your clients. So let's move to the next slide. So we've had an insurance claim. How does that insurance claim get treated? How much goes into the tax-free, the taxable taxed, and the taxable untaxed component? Now this is, as I said, a little bit complex. There's some mathematical formulas here, and I'm not going to go through the formulas in a lot of detail, but essentially, though, before I get onto those formulas, the key thing to keep in mind is that if your premiums were being paid from a reversionary pension, then what happens is the pension components remain fixed. So if that pension was 100% tax-free, then essentially the insurance benefit becomes 100% tax-free. If it was 50-50 tax-free versus taxable, essentially that insurance benefit becomes 50% tax-free, 50% taxable. But most likely the premiums won't be paid from a reversionary pension, because typically older people don't have as much insurance. Most likely they'll be paid from accumulation. But if they were paid from either accumulation or from a non-reversionary pension, then the insurance claim is going to go into the taxable component, which is not great, because essentially the beneficiaries may end up paying tax on that insurance claim. So they have their insurance in super because they get a deduction on the premium, but they potentially could end up paying tax on the benefit, especially if the recipient is an adult child. So really important to understand that. So here's the formulas I was referring to a second ago, and they look on the surface pretty scary, and maybe they are. So don't try and make sense out of them. Don't try and understand the logic. Just recognize that this is how the components work, and the outcome of this is that a large proportion of the insurance claim is going to end up in the taxable component and potentially the untaxed taxable component, which, as we'll see in a moment, could be taxed at up to 30%. So keep that in mind, and this is particularly important for understanding whether your client's insurance should be inside super or outside super. I think the belief that's out there that life cover should always be in super is not necessarily the case, and it depends on who the beneficiary is going to be, how old the member is, and how many years of service the member has had. So keep all of those things in mind. Once again, if you can get on top of all this, great way to differentiate yourself from your clients. Okay, so now let's suppose your client has passed away and we have to work out how much tax do they need to pay on their lump sum benefit. Well, if the beneficiary is a spouse, or for that matter if it's a genuine child, someone under 18, then that's all going to be tax-free regardless of the components. But if it's an adult child who's considered by SIS to be a tax non-dependent, then they'll have to pay potentially 15 or even 30% tax on the insurance benefit, which will wipe out, or could wipe out, the benefit of the tax deduction that they were getting on the premiums. And then there's Medicare added to that as well. So keep that in mind when you're working out the tax on a lump sum. And then if it's an income stream benefit, and I really have oversimplified this, this slide could have been far more complex, but generally if there's a tax-free component and your client pays their death benefit as a pension as opposed to a lump sum, if they take that as a lump sum withdrawal out of the pension, and we'll explain all this in a lot more detail at our next webinar next week, then there's potentially some tax payable there if there's a taxable component, and there's also, especially if the recipient's under the age of 60, and then if there's a regular withdrawal, there's potentially also some tax payable if the recipient's under the age of 60. And look, this is all more complex than what I'm putting down here, and as I said, we will talk about this a lot more in our webinar next week. We just don't have the time today to go into that much detail. But the key point that I'm making is be really careful when you're working out how death benefits are taxed, and also be really careful in making sure that while your clients are still alive, that all their insurance is structured in the best way so that they won't have to pay any unavoidable tax upon their... Oh, sorry about that. Just lost our slides there for a second. They won't have to pay any unavoidable tax on their death benefit. Okay, so there we go. And let's move on now to the conclusion from this section. So, once again, ensure that all the tax components are calculated correctly. Now, your client can't point the finger at you if they're no longer alive, but they might just smile at you from heaven. So, once again, it is really important to make sure that you get all these things right. Okay, so we've talked about the tax issues. Let's move now on to some issues relating to the actual payment of benefits once one of your clients has passed away. I think there's 5 really important questions that you should be asking here. There's probably a whole lot of other good questions too, but these are the 5 that I consider to be the most critical. Now, I'm going to say here, I'm not an estate planning lawyer, and there's many people around who can go into lots more detail than this, but I want to give you some of the key things that I think you should be considering. So, 5 key questions to ask. Who is in control of the fund? Is there a valid binding nomination in place? Is there a reversionary pension? If not, can a pension be commenced, and should a pension be commenced? So we're going to go through those 5 questions now, and we're going to start off with the first 2 questions. So who's now controlling the fund, and is there a valid binding nomination? And these 2 go hand in hand, because if there's not a valid binding nomination, then who's in control of the fund is absolutely critical. So let's have a look at some of the things that you need to take into consideration to understand who's in control of the fund. And the rules for this are not straightforward because you may have to look at a whole range of different documents to work out who's now controlling the fund when one of the members has passed away. You may have to look at the trust deed. You may have to look at the will, and I don't say that because superannuation benefits are dictated by the will. I say that because there could be a trustee company in place which is in control of the fund, and you have to look at who owns the shares in the trustee company because that person may be able to replace the directors of the fund and then take control of the fund. And you could then have a situation where the directors are no longer the members, and that creates its own separate issues. You'd want to look at the share certificate to see who the directors are today, and perhaps the constitution to see what the voting methods are in the fund, and that could be written in the trust deed as well. So for example, if there are 3 members in a fund and one person has a balance of $1 million and the other 2 have a balance of $100,000 each, then how does the voting work? Is it a majority decision based on each member gets 1 vote? Or does each member get a vote based on the amount of money they have in the fund? And the answer is, I don't know. You have to check what it says in the trust deed and the constitution. So these are really important things to consider. But all in all, these are going to dictate who controls the fund in this situation. And that person who's in control, or people, can wield a lot of influence, as we'll see in a moment. So it's also important to check if there's a binding nomination. A binding nomination needs to satisfy these criteria. It needs to be signed. There need to be 2 witnesses who cannot be the beneficiaries under that nomination, and generally it will have a 3-year shelf life. Not always, but generally it will have a 3-year shelf life, so it expires after 3 years and then it becomes no longer binding. So you do need to keep updating this every few years, and that's a real trap that many people fall into because they forget to update it. So let's have a look at what happens if, for example, the binding nomination has not been updated and it becomes a non-binding nomination. So there's a number of cases around this. This here is one of the most famous ones, and many of you will be and should be familiar with it, and if you're not, you're about to be, and it may very well scare the hell out of you, and then you'll become even more familiar with it because you'll probably go and do a bit more reading. But this is the case of Mr. and Mrs. Katz. The legal case is called Katz versus Grossman. Mr. Katz and Mrs. Katz were married. They had a self-managed super fund. They were the only 2 members. They were the individual trustees of that fund as well. They had 2 children, Daniel Katz, their son, and Linda Grossman, who I'm assuming was Linda Katz, and then married a Mr. Grossman, and she was the daughter. So everything looks pretty standard at this point, and I'd say that you would have lots and lots of clients who fit into this exact situation. And then something unfortunate happened. Mrs. Katz passed away, and because the fund had individual trustees, Mr. Katz was required to appoint a second trustee, and he did that. He invited Linda Grossman, his daughter, to become a second individual trustee of the fund, which she gladly accepted. So now we have this situation. We have Mr. Katz. He's the father, he's the individual trustee, he's a member of the fund as well, he's got $1 million in super, and he had a non-binding nomination which split his superannuation benefit 50-50 between his 2 children, Linda and Daniel. Linda was his daughter, and she was also an individual trustee, and Daniel, apart from being a beneficiary under a non-binding nomination, had no involvement in the fund whatsoever. And then Mr. Katz passed away. And so the question is, who is now in control of this fund? And the answer is Linda Grossman is in control of the fund. And so she then looked at this $1 million benefit and said, how am I going to pay that $1 million benefit? She saw that there was no binding nomination in place, and so she had discretion within the rules of the trust deed and within the rules of SIS. She had discretion as to how that money would be paid, and both the SIS and the trust deed said that it could be paid to any children of Mr. Katz. So she pocketed all of the $1 million. Daniel Katz took legal action and he was unsuccessful. And that's because Linda Grossman was in control of the fund and she had absolute discretion as to how to pay out that benefit, despite the non-binding nomination and despite Mr. Katz's wishes. And there's been other similar cases to this more recently, but all of the cases point in the same direction, and that is if you don't have a binding nomination and you can't control who is going to control your fund in the future, then your client is taking on significant risk. As I said, this case scares the hell out of me, and hopefully it scares the hell out of you as well, and hopefully you go back and make sure that every single one of your clients has a binding nomination in place. So one of the things you're going to do if your client passes away is you're going to look at who's in control of the fund, is there a binding nomination, and if you're not sure, make sure you get some good legal advice for your client in this field. So let's move on to the next two questions. Is there a reversionary pension? This is a really simple question. If the answer is yes, then great, and that pension will continue. If the answer is no, then you have a choice to make, and that is the benefit going to be paid out as a pension or a lump sum? So we have to start off by saying, well, are we allowed to pay it out as a pension? So let's have a look. It can be paid as a pension depending on who the beneficiary is on the left-hand side, if we've got a yes written in the right-hand box. So the most typical examples are a spouse in the top right corner or a former spouse. In that case, a pension benefit could be paid because they are considered tax dependents under SIS. But the really important one to understand is that if it's a child over the age of 18, that a pension benefit cannot be paid. It has to be a lump sum. In every other situation, just about, then yes, a pension benefit can be paid. And of course, right down the bottom, a pension benefit can't be paid if the benefit is being paid to the estate. But most commonly, if it's being paid to a spouse or a child under the age of 18, then certainly you can pay a pension benefit. So then the question arises, do we want to pay a pension benefit or not? So I've tried to really simplify this for you, and as I said, it is a simplification. This won't apply to every one of your clients, but it will certainly apply to the majority of them. So we now move on to this question, should a pension be commenced? And I've put together a bit of a flow chart here, and I start off by asking, is the beneficiary over 60? And if they are, then most likely you would want to keep the money in the super fund and pay a pension, and because they're over 60, they can potentially start getting some money out of super there as well. If they're not over 60, then we have to ask the question, do they need the cash? If they need the cash, then it's really simple. We have to pay it out as a lump sum. If they don't need the cash, well, you may as well leave the money in super, which is the most tax-effective vehicle for them to be retiring. So that's my very simple flow chart on the payment of a death benefit. A few administrative issues for you to consider. So if you are paying a lump sum benefit, it should be paid as soon as practicable. You can't leave the money sitting there in the fund forever. You should pay it out as soon as you can. Now, of course, there are some reasons why you might not be able to. You might have a property in the fund and you need to perhaps wait till the property's sold, or there could be an investment in an illiquid asset, maybe a managed fund that's frozen redemptions for a while. But putting that aside, as soon as you can, you should pay the money out, and it should be paid out in a maximum of 2 installments. And you should make sure that you notify ASIC and the ATO, and you should do that reasonably quickly to avoid any fines. So make sure that the deceased party is removed as a director of the trustee company or as a trustee of the fund, and also as a member of the fund. And you need to notify ASIC and the ATO as appropriate about those things. And then you may need to wind up the fund as well if this was the last member, or alternatively, if the person who survives as a member is no longer suited to being the trustee of an SMSF. So conclusions from this section, make sure you consider all of those 5 questions. And once again, if your client receives a penalty from the ATO or from ASIC for not following those rules, they're going to come knocking on your door. So make sure you get all of these things right. Of course, it's not only about avoiding the penalties, it's about you knowing that you can sleep at night having delivered the best possible advice and service to your client and differentiating yourself from all of the other accounting firms that are out there. And I can assure you there are many of them that are not doing these things properly. Okay, so I'm just going to make a few concluding comments now, and that should leave us with about 10 or so minutes for questions, which depending on how many questions there are, will hopefully be plenty of time, but we'll see. So getting things right is absolutely paramount, and that's why I want to share some of my ideas with you today to help you make sure that you do get things right for yourself and for your clients. If you don't get things right, then, as I said, you risk being blamed by your clients or having a penalty imposed. And what's more, it's good just to be able to sleep at night and know that you're doing the right thing. We have another webinar next week. The topic is 5 simple tips to save lots of tax using SMSF pensions. I know that many of you have already registered for that webinar. If you haven't, you're most welcome to. The registration details are there. I'll give you a moment just to copy those down. And that starts at 10:30 next week, Sydney time or Melbourne time. One person called me last week and said, what do I do? I'm not in Sydney or Melbourne. So you can still log in, of course, but it's just going to start at an earlier time in the day if you're in a different part of Australia. So that's next Tuesday, exactly 1 week from now, starting at 10:30 in the morning on Sydney. So hopefully you've all had a chance to grab that address. If you don't, just send me an email. My email address is on our website, and remind me that you want to register and I'll send you the link. Okay, bonus offer. Look, I really want to say thank you to everyone today for attending. It's one of my objectives to improve the level of knowledge in the SMSF industry, and by attending today you're helping me do that, and I want to say thank you by giving you a free actuarial certificate valued at $110. If you'd like to take advantage of that offer, then send me an email today. There's my email address. That should be reasonably easy to remember. It's greg@limeactuarial.com.au. Send me an email today, and I'll help you obtain that free actuarial certificate. That expires at the end of January. I think that should give everybody plenty of time to use that. Limit of 1 per business. So if there's 5 of you on the call today, all from the same business, please just coordinate between yourselves. And I've said valued at $110. I got the question last time I made this offer, but I thought actuarial certificates cost $176 or something like that. Well, it depends who you use. Well, one of the things we're about is making things really affordable for accountants and for trustees, and making things easy and fast as well. So we've brought the price of actuarial certificates down in the industry, and a lot of our competitors are feeling they need to follow that as well, and that's because we've broken ground there. So yeah, $110 plus GST is what we charge for each actuarial certificate, and therefore that's what you're saving. So that's the end of the formal presentation for today. As I said, we've got about 10 minutes left. I'm going to now start asking questions, so feel free to stay on the line and hear your question answered or somebody else's question answered. As I said, I will be sending out a copy of the slides, and also I will be sending out a copy of the slides and also a recording of the video as well. So stay tuned for that. It won't be in the next 24 hours. It'll be over the next few days. Let's move into questions here. Okay. Okay, looks like we've got quite a few questions, which is great. Okay, sounds fine. SMSF can only have 4. That's from Philip. That looks like a comment more than a question. I'm not sure what that's referring to. So Philip, if you'd like to elaborate on that, feel free to send me any elaboration on that. Okay, that is dishonest. Also from Philip. Gee, Philip making lots of comments here. I'm not sure what he's saying that was dishonest. Hopefully I didn't say anything that was dishonest. I'm not sure that I did, but Philip, once again, if you'd like to type in what it was that was dishonest, I'm happy to discuss that further. Okay, with regards to insurance and retail industry funds, should we keep? Oh, I think what Philip's saying is dishonest is keeping $10,000 behind because you're not doing the right thing by the industry fund. Look, I'll leave it to you whether that's dishonest or not, but certainly the insurance, the industry funds are wising up to that. So if it is dishonest, they're calling your bluff and your dishonesty. Okay, question from Luke. With regards to insurance and retail industry funds, should we keep the minimum balance and make at least one contribution in the year to maintain the insurance? Look, that's really up to you. So Philip says he thinks it's dishonest. I think dishonest is the wrong word. I'll leave it up to you whether you think it's the right thing to do or not. And I won't make any judgment on that whatsoever. You just have to decide what's right for you and what's right for your clients. And if you do think it's the right thing for your clients, then have a look at what the rules are of the industry fund and make sure you comply with that rule. So if their rule is you need to have a balance of over $10,000, well, that's what you do. If their rule is you have to make a contribution once a year, then make a contribution once a year, even if it's a non-concessional contribution of $10. But whatever it is, just make sure you follow their rules and you're thinking about it rather than just blindly putting in place a strategy without giving it any thought. Why not take insurance outside super? So, and this is from Philip again. So Philip, you can take insurance outside super. There are 2 reasons why people put insurance in super, and one is that there's a tax benefit. The premium is tax deductible, and depending on who the beneficiary is and how old they are, the benefit may or may not be taxable. So one is that it can be tax efficient to have insurance in super. And the second reason many people have insurance in super is an affordability, a cash flow issue, that they just might not have the cash to pay for the insurance outside super. It could be that they've got a mortgage, they've got school fees, and they say, well, super's a great way of helping with my cash flow in paying for the insurance premiums. So there's a couple of reasons why people do put their insurance in super. Cross-insure, Philip. Yeah, so Philip suggested cross-insurance, which is essentially where I got to, is Mary pays for the insurance on John's life and John pays for the insurance on Mary's life. So thank you, Philip. That's the right answer. If John and Mary are married, this question's from Luke, if John and Mary are married, why would you pay out John's balance? Luke, it's because under the superannuation rules, if John's balance was used to pay the premiums, then John's balance needs to be the recipient of the insurance benefit. So you don't have any choice there under the superannuation rules. Of course, you should check the trust deed as well, but I'm pretty sure that that's what you're going to find. So it's not a choice that you have. Now, I'm guessing there's quite a few of you in the audience that are sitting here saying, oh, well, I've always done it differently, and in that situation, I've just paid the insurance benefit out to John. Well, I'm sorry to let you know, but that is probably not correct, and your client may very well have breached superannuation rules there, and if they have, and the ATO was to find out about that, then your client could have an issue. So that's the answer there. Any tax on the insurance proceeds? So Phil, I think I've covered that now. Philip, thank you. Okay, Ben, we've got a new question asker. Why not just have the original $1 million premium be deducted from Mary's account? You could have it deducted from Mary's account. So firstly, you have to actually do that. It's not enough after they've died, after John's died, to say, well, why not deduct it from Mary's account? It's too late then, because you've been deducting it from Philip's account for all those years. And secondly, as I said earlier, you don't get a tax deduction on that premium where there's the cross insurance in place, and so you don't want to have too much insurance being deducted from the other member's account. So only have enough there just to cover the member's balance plus a little bit of a buffer, and then have the rest of the insurance being deducted from the member who is receiving the insurance benefit. In other words, sorry, whose life is being insured. Okay, there's some great questions that are coming through here. Isn't the easier solution from Luke to have the premium paid by the trustee and not by the member's balances? So Luke, when you say the trustee, I think what you mean is by the trustee outside superannuation. This is the same question that was asked a few minutes ago. Why don't you pay the premium from outside super? I think that's what you're asking, Luke. And I did just explain the answer. Yes, it could be easier, but there's two reasons why you might want to do it from within super. Firstly, there could be a tax benefit, and secondly, cash flow issue for the trustees outside superannuation. Okay, the next question from Philip. Well solved, and tax deduction explained also. Okay, excellent. Thanks, Philip. I'm glad I answered that one. Okay, Philip, who owned the policy is critical, not the account deducted. So, Philip, I'm going to take a different view from you there. Who owns the policy is certainly important. It needs to be the super fund that owns the policy. Where the premium is deducted from is also important as well. Not clear on the account deduction. Is it the owner on the policy or the beneficiary? I'm not sure what you mean there. Are you asking about the payment of the premiums, in which case it comes out of the member's balance, whichever member we choose to deduct the premium for? There is an option to pay it out of reserves as well, but I think that overcomplicates things and it creates other tax issues. So if you're talking about the payment of tax on the lump sum, that's paid by the beneficiary when they receive the tax benefit. Now, member statements is a big issue for accountants unless they use software to do it. A big liability. Yes, Philip, that is correct. You'll attend the next webinar. Excellent. We'll be glad to have you along. And software certainly does help. And there's now some very low-cost software for those people that want to take advantage of it that can do this. In fact, in some cases, free software that will do that for you. And there's other software that is has more functionality and does cost more as well. Or you can just make sure that you perform the calculations properly with your own spreadsheet. Okay. Who will know these things on death? It's a really good question. So if you're talking about your client, then hopefully you should know these things because you're their accountant and the fund will continue, and the survivors will come to you and say, hey Philip, you're my accountant, can you help us work through these things? If you're talking about your own personal fund, yeah, that's problematic. You either need to leave really good notes for your family members or perhaps for your business partner, or outsource your fund to somebody else today so that everything is all looked after, and upon your death, your accountant will still survive you and can continue to make sure everything's done properly. Okay, Philip, lucky I'm not charging you by the dollar for every question you're asking. There's some great questions here. I'd be a millionaire if I was. Okay, but please keep them coming. It's great to have this many questions. Okay, their beneficiaries can blame you. Yes, Philip, you're right, they can. Even if the deceased member is no longer here, their beneficiary certainly can blame you, but at least if things are done properly, then the deceased member will smile upon us from heaven. Philip said, all very good questions, as control is king. Control certainly is king. Jenny, good to have you asking a question, Jenny. Thank you. Will it be better to hold insurance outside super and SMSF? What are the advantages and disadvantages? So I think I've now answered that question, Jenny. We've had that question a couple of times already. I'm assuming this says Lorraine. The interface I've got only gives me about the first 5 or 6 letters of somebody's name, so I'm assuming this says Lorraine. Is there a preferred binding nomination template that can be used? Look, what I'd suggest you do here, Lorraine, I don't want to be seen to be promoting one service over another in a public forum, especially because I don't know enough about your situation and the services that you're looking for and the trustees you're using and so on. But Jenny, if you'd like to give me a call or send me an email after this session, I can chat to you to find out a bit more about your clients and how your business works, and I can certainly then point you in the direction of somebody that can prepare some binding nomination templates for you at a very, very low cost. So and that goes for not only for Jenny but for anybody else. Oh, sorry, that was Lorraine that asked that question. Sorry, Lorraine. Yeah, so if you want to contact me afterwards or anybody else wants to, I can certainly do that. Philip, thanks, Greg. Plenty of issues to solve and questions to answer. Yeah, sometimes you think of more questions in these sessions than answers, but hopefully I've been helpful with that, Philip. Ben, what is the cost for next week's webinar? Ben, same cost as today's, no cost at all. And that's really because I want to be able to help people improve their knowledge. And I know that if I charge money, then that will be a barrier to people like yourself and everyone else on today's webinar attending. And I don't want any of you to have a reason not to attend. So absolutely free. Print screen does it. Good, glad to hear that. Okay, Philip, only 4 relates to highest member numbers. Just kidding. Okay, thank you. Dishonest insurance company to keep the premium, not pay the benefits. So as I said, look, that's really up to your own values, and some people will say they're comfortable, some people will say they're not. Okay, if a member dies and has life insurance, can it be a journal entry as a non-concessional contribution? I'm just going to read that question again. If a member dies and has life insurance, can it be a journal entry as a non-concessional contribution? So that's so the spouse does not need to be solved. That's a fantastic question. If I was giving a prize for the best question of today, there's been a lot of good questions. I think I'm going to give Ben the prize here for the best question of the day. So what he's saying is, can you just make a journal entry? So there's 2 parts to the answer to this question, Ben. The first is, no, contributions and death benefits can't be journal entries, so the money needs to come out of the fund and go back in. But there is an alternative, and that is, can you put the money into the fund first? So could the surviving spouse, could Mary, for example, make a non-concessional contribution of $100,000, and then the fund will have enough cash to pay out John's death benefit? And the answer to that question is probably, but Mary needs to have the cash. So where's she going to get it from? It could be that she has another life insurance policy, but it could take a long time to get the proceeds of that insurance policy paid. It could be that Mary has some money sitting in the bank, has maybe some shares that she can sell, or perhaps a redraw facility on her home loan. Of course, it could also be that all her assets are frozen because there's a disputed will going on. So keep all of those things take all those things into account. So Mary may or may not be able to make a non-concessional contribution in this particular situation, but certainly the journal entry won't be satisfactory. Okay. Luke has then asked a question. No insurance premium to be paid by pooled funds, not the member's balance. He said, So ultimately, every premium needs to come out of a member's balance unless there's a reserve. So I'm not referring here to whether the fund has segregated assets or not, but ultimately the premium does need to come out of one of the members' accounts. Okay. How does the loan for the property get paid? So Phil, I think what you're asking is there was no cash in this particular fund. In reality, there always will be a small amount of cash of 10,000 or something like that, or maybe there's a redraw facility, or an offset account, or something like that within the fund. More likely an offset account than a redraw facility. And of course, there's contributions coming in, and there's rental income as well. Okay, Jenny said yes. Thanks, Philip. Death benefit nominations usually found in the trust deed. Thank you, Philip. Excellent. So that is all for today's questions. So hopefully you've all found that to be helpful. We're going to finish up there. If you do have any other questions, feel free to send me an email. My email address is there on the screen. Don't forget about next week's webinar, which is free. And don't forget that if you'd like a free actuarial certificate out of today, then just send me an email as well. So we're going to wrap up right there. Thanks very much again, everybody, and I hope to see you at next week's webinar. Bye for now.